Today's webinar is on the deals that you need to do to develop medical devices, and in particular, the deals around the raising of capital. And it's a pleasure today to introduce Kim Lyle, who is the chair and the director of a company called Electrogenics Laboratories, which is developing a radiation dosimetry device. And I should share also up front that this device is being developed. It's a client. So Electrogenics is a client of Genesis Electronics Design, which I'm also an employee of. So we are working together on this project. And towards the end of the presentation, we'll share a little bit about the actual project itself. But the majority of this webinar is really about that all-important topic of raising capital. So with that, I'm going to hand it over to Kim Lyle to provide a little bit of his own background about who he is, and then talk about his cunning plan here. Over to you, Kim.
Well, thank you, Tim, for inviting us to speak today. Yes, a cunning plan. My own background, I've worked in the capital markets for the last 30 years. I used to be, many years ago, the national sales manager for ANZ McCorns, the stockbroking arm of the ANZ Bank. And I've been doing IPOs and reverse takeovers and corporate consulting, as I say, for that last 30-year period, but with a particular emphasis on raising capital. So I put together a fairly simplistic slideshow today, just to get some general concepts across, so that I'll fill in the gaps with an overlay of how we've applied these general principles to electrogenics. So to start with the first slide, got a great idea. What next? So I have a cunning plan. You got to work out what exactly that cunning plan is, and does everybody else think so? I saw this on the net the other day, and it's anyone that's over 60 and own valve amplifiers will know what it's all about straight away. But it just looks like a fantastic product to me. It's a vacuum tube that is used as a microphone or a nearphone powerer. Theoretically, it's electrons through a vacuum. So it should be like 10,000 times faster than the fastest transistors out there. You can control the volume in the digital domain as well as equalizer. So it's just a perfect put together. I would buy one tomorrow. But everyone else I've shown this to laughs their head off and says, "You've got to be kidding, it's out of the ark, who would want to buy that?" So it might seem like a great idea to you, but you really need to do some solid thinking and say, is there really a market for my product? It's a pretty obvious first step. Every mother loves their baby, but so do mother skunks. Not necessarily, and no one's going to take that one home. Just to overlay electrogenics here, I looked at probably 100 commercial opportunities from the CSIRO, the University of New South Wales, University of Sydney, University of Wollongong. Our radiation sensor, the one we're commercialising currently, really jumped out of the pack.
Kim, can you tell me why? I'm really interested. First of all, were all of those 100 opportunities you looked at, were they all in the medical in the space, or were they just across industries?
Probably across industries, but probably 30 to 40% would have been in the medical space. And there were various reasons. Like, for example, if it's a pharmaceutical product, you're probably looking down the gun barrel of it up to 10 years for trialing. So it's a long, slow haul. You've got to show efficacy milestones all the way through. This was a device that had been extensively tested and already proven. So they had 40 published scientific papers. The principal involved in inventing it is recognized as the world's leading authority on medical radiation dosimeters. And probably most importantly, it targets a mature market. Okay, so the dream deal is not so much inventing a product or identifying a product and then finding a market for it. It's actually identifying a mature market, ideally, and then having a product that puts that market on its ear. It's a fraction of the cost. It outperforms all the, so it's a mature industry where you bring a device along that it's going to have a significant impact and be a game changer for an industry that's already turning over and knows what it's all about, maybe $1 billion a year. So that's a great starting point.
What I'm really interested in, Kim, is you're not starting with the idea. But I'm really interested in this process where you basically you're starting with the money. I take it that you're an investment company. You're looking for an opportunity to invest, and then you're looking across multiple industries, and then in the medtech across multiple technologies in multiple subsectors of the medtech market. Before arriving at that, that's quite a different approach to generating a medtech project. Most people start with this. I can see a need, in a particular medtech area, and I'm going to think of a solution for that. It's a very different kind of approach, isn't it?
Yes, look, it's a quasi broker approach because I'm looking for opportunities to bring in networks and I guess a skill set developed over 30 years. Whereas you don't necessarily start with that when you're creating your own baby. So I guess I'm a foster parent in that regard. We're taking other people's technology and then commercializing it.
But I do think that general philosophy. Let's say, for example, you're a cardiologist, and you know a lot about cardiology, and there are all sorts of issues. But and you may, and this is what mostly people start off with this idea that they have, and they want to see if they can come up with a solution and a particular technology. But if you're a cardiologist and you look, and it's a big field, there's several associations in the field. If you looked across the whole world at, 50 different potential investment options across that field, before deciding which one you're going to focus on, that's much more of an entrepreneurial approach. You're coming from a commercial perspective right from the start, rather than a technology or even a medical perspective.
Well, I guess, look, that's exactly what this slide's all about at the end of the day, is who's going to buy it. I'd actually give you a practical example of what you've just raised there. It wasn't cardiac, it was actually a vascular surgeon. And apparently something like a quarter of the world's population suffer from varicose veins. That's where the vein, basically the walls of the vein pack up and they bulge and can become very, very serious effects. What they generally do in hospitals is you're there, they strip the veins out, you grow new veins back. You've got your legs bound up for 6 weeks, can't walk for 2 or 3, and basically you're significantly impacted. So it's a traumatic and very expensive exercise. He developed something that looked a little bit like a Band-Aid, but more like a crutch, I guess, in a sense, that you go into day surgery, they would actually put this around the varicose vein, tighten it up, so give that vein wall support, and you would walk out of the clinic the same day. So the savings for the hospitals were massive. It immediately qualified for a $1,000 rebate under Medicare. Very interesting, considering the actual manufacturing cost was around $12. So the margins were sensational. But the impact of that piece of technology, 6 weeks out of hospital, no impact on a worker's ability to go back to work the next day. A simple procedure that took hours, no anesthetic or negligible anesthetic involved in the exercise or local. So that's what I mean by at a quarter of the world's population affected by that particular complaint.
So market size is really a beginning criteria for you. When you were looking at those 30 or 40 other medtech opportunities, did you have a particular set of criteria, and did you do, was it gut feel, or did you apply some sort of rigorous analysis of them?
No, it was look, one of the big applications for our particular technology is monitoring radiation treatment for cancer. That's also diagnostic and interventional scans and so forth. So it's got a broad spectrum, but that's one of its major focuses. And I think very, very simply, it's very, very few people that don't know someone directly or in a third person scenario that haven't been affected by cancer and that haven't had radiotherapy as a treatment for it. So I was aware, and I lost a sister and a mother-in-law, pretty much both from the side effects of radiotherapy. So yes, it was something that everybody in the marketplace understood. Everyone's aware of it. It's not that difficult to get the message across. And basically, when you talk about reducing the risk of dying from the cure to cancer, ears prick up, and there's a lot of interest. So it's an easier market to penetrate, less education required. They were the boxes that ticked it for me.
Excellent.
Can I just look to the next slide? We'll give you a look. This touches upon what we've just covered then, Tim. At the end of the day, you've identified a market, you've identified the product's going to work. You have then to step back and survey the landscape and work out how you're going to get there. Okay, and the point of this slide is that there's more than one way to get to the ocean. So a good example of this is you can try and do it all internally. For us to bring in our own design engineers, work with the university, we would have needed massive amounts of capital. They would have become basically fixed costs for the business. And we're taking a punt on that expertise being of a sufficient standard to produce the right product at the end of the exercise. The alternative to that, so it's an alternative route to the ocean, I guess, by way of comparison to the slide, was to engage, well, in my view, Genesis is the leading firm in Australia in terms of electronic design generally, but in medtech as well, in particular. You bring in the best guys in the country. In some senses, it's a little bit more expensive than trying to do it in-house, but you've got a premium product that's going to come out of a premium research team, and your costs are controllable to fit your cash flow available at the time. So that's just an example of two different approaches to the same objective at the end of the day. You've got to see what works best. So as I say, stand back and have a real hard look at the way you want to proceed, how big a team or how small a team you need, and who are the right people to get involved.
Sure. And the other, I should mention the other company involved is Designer Industry, doing the industrial design aspects of it.
And I think they're pretty much unquestionably Australia's leading industrial designers. Their work is superb. So I'm a little bit lucky. We've picked the cream of Australian engineering expertise to work on this product. I don't believe I would have gotten anywhere near the standards we're getting currently if I tried to engage and do that internally. Having said that, if you're the inventor and you know your technology back to the front, then no one's going to know it better than you. So it just depends on what you're trying to market, what the idea is, and as I said, there's quite probably a third or fourth or fifth strategy that might fit even better.
I'll make the comment there is that, and that is that an inventor might know their particular technology well, and usually they bring something to you, like for active medical devices, it's quite often an algorithm of some kind. It's quite often in the software, occasionally in the hardware, in a unique sensor or something, or a stretchable fabric with sensors woven into it or something like that. But the point about medtech is no single person can be an expert across all of the domains of knowledge that you need to bring the product to market, at least all the commercial side of things. So, which is why we're listening to you today. So yeah, it's always going to be a team effort regardless. And, unless you're somebody like ResMed or Cochlear, you're never going to have all of the expertise you need in-house. You're always going to be outsourcing, a significant percentage of what's needed to bring the product to market.
100%. In fact, in my view, personally, I think that outsourcing in almost its entirety is the commercialization model of the 21st century. That outsourcing, obviously, in our case, includes outsourced manufacture. We're outsourcing distribution because we're working with established distributors. We're not trying to, employ an in-house marketing team, which generally consumes about 30% of your gross profit margin. Anyway, so it's not necessarily cheaper. You can give that same margin to an established distributor. So we've got a very tight professional team that actually drives very close to 100% outsourced model. That's the model we've taken. It doesn't fit all, but we're quite happy with it. Just to skip on through, this is okay, see if we can get this to work. That's not showing up. Okay, so start with the foundations is what this slide is all about, and it's pretty obvious why it's relevant. When it amazes me over the years, I've had people come to me and say, look, we've got a great product. This is a company, sounds fantastic. We think it's potentially worth billions, where we want to raise $3 million for 10% of the company. You say, sure. So what have you got? You've got an idea, right? And you're valuing your idea at 10%, $50 million, $45 million pre-raise. Straight away, it's a fantasy. So you've lost credibility out of the gate just on the basis of your valuation, because an idea, okay, you might have it will even pay. Was it pay later? All these different techs.
Afterpay.
Yeah, exactly. So they've taken a long time to get that model right. Right guy, right time. There are success stories, but there's probably 999 or 99.9% failure. You can't be distracted by the one odd success. There is a formula. So again, foundations are fundamental. One of the really great examples is that they've got a valuation and they say, okay, so we've got 10 shares on issue. We want $1 million, so you get 1 share for $1 million. So straight away, that screams the guy's a complete amateur, has no idea of finance, and is the end of the game before he gets out of the game. So work out with your foundations. Work out where the company's going to be in 3 years, and then build the basis for that. So say in the case of Electrogenics, we've actually, I like public companies. I like taking them public because it's significantly more protection for investors. The board are more accountable. The accounts are audited. You get a higher profile. You access larger capital markets. But it's a tough road. Unless you've got a lot of experience in it, it can be a very painful and tough road.
Can you just, while we're there, can you quickly talk about the structure of the company? You've got a board.
No, precisely.
And shareholders.
Yeah. So we want to know at the end of the day, our intention is to list it on the stock exchange. And the stock exchange, we're going to put a number of shares out, and I'm thinking probably in the order of 30 million shares. I know what the valuation is. So the point at the very start of the exercise, we've issued 30 million shares as founders. Okay. Once you've issued those shares, you can't 6 months later say, well, we've got some money in, but we think we might issue ourselves some more. That's just not possible. You'll get sued. It's not ethical, and so forth. Okay. So you've got to get your foundations right day one, because what is allocated is what you're going to wind up with at the end of the day post-dilution. We issued 30 million shares. Then we sought to issue, or are in the process of seeking to issue a further 16 million shares for 35% of the business. This is a great deal for investors coming in. And then what we'll look at doing is issuing a further 20+%, maybe 25% of the company in 12 months' time in an IPO, and ideally at a double or triple premium to this first round of capital raise. So we've worked out the number of shares we have to start with. We've worked out the number of shares we ideally want to end up with in the marketplace. We've worked out the capital that we are likely to require, and I'll get more to that as we go on. So we've got the structure right. And of course, in our case, the university spent 8 years developing this. They spent $8 million in just cash grants from the Australian government, in addition to their own resources and the resources of 20 hospitals and clinics around the world. So when you actually add up dollar values to that, they probably spent close to $30 million developing the tech. It's academia, so money doesn't matter. But we've said, okay, we want a conservative valuation. We want to see this get on the marketplace. We've simply taken the value of the cash that was actually spent developing the tech. The university could say, if we cost out our time, the hospitals, if we cost out our time, there's another 20 million, but that's an impossible calculation and you're not going to get those numbers back. We are able to point to firm documentation that says, hey, $8 million was spent on this tech. That's that. And so it's a very realistic and conservative valuation. Investors know it's real. It's not a notional or a theoretical valuation. There's substance to it. Okay, most people won't have that benefit. So you have to then justify that valuation, and there's ways that you work that up, which I'll come to in the next couple of slides. Is that clear? Is that clear enough, Tim? Would you have questions on that?
Yeah. No, that's great. I did want to. There is a question I'll get to in a minute, Dan. No, just I was interested. Like, this is probably sounds like a naive question, but most companies Genesis deals with are sole proprietors. They're an entrepreneur who runs and owns their own business. I'm really interested in the fact that you've gone to a public company straight away, and you've got a shareholders. They're all you've already got seed investors, haven't you? And I know you had a board meeting in an annual general meeting, and you've got a board. So can you just quickly describe the structure of the company and those sort of basic items, and why you chose to do that rather than try and raise the money privately?
Well, we have raised the money privately, but we've put together a vehicle that people can invest in. Okay, so if you're a sole trader and want to say, "Hey, give me money," you're basically, what are you giving the investor back in terms of equity in the opportunity? So sole trader isn't going to work unless you actually execute something like a limited partnership. That's quite onerous and difficult, and actually it's a hard structure to sort of raise capital on. So you really have to go to a company structure. Probably you generally start with a proprietary limited, because the cost of that's quite low. It's about $1,000 to set up a PL company. Couple of interesting things here, though. I'm glad you raised this, Tim. We get back to the foundations. A lot of guys say, "Well, I've got a great idea. I've actually put a patent on it, right? But I'm going to license this proprietary limited company because I'm going to keep the patent to myself, because if anything goes wrong, I'm going to, I've still got the patent." So if I'm an investor, and let's say $5 million is raised and it all falls over and you get the patent back, then you've got the benefit of $5 million expenditure, and the investment gets a sincere sympathy card because they've lost their dough. So that's a hard structure to get people to invest in, and one that I would walk away from immediately. So ideally, the company should own the IP, right? Or that's the ideal scenario. The previous one I've talked to you about, where they've got a license that may or may not benefit from the capital raised, or the shareholders may or may not benefit, because it's soft ground they're working on. Having said that, with the university, we actually have the commercialization rights. The university owns the patents, right? But we have the right to get this deal done. We have the right to acquire those patents once we've raised a minimum of $3 million. So we've structured this around effective ownership on a trigger event. That made it more comfortable for the university to give us the exclusives. It made it more attractive for investors to come in, because we know we'll be exercising it for $1, or $100 in this case, to actually secure the patents. So again, it's the way you bolt the deal together. But IP is pretty important, and if someone's going to invest in a company, you should ideally have ownership of that IP by the company. Does that cover your points, Tim? Is that where you were coming from?
Yes, and maybe later on in the presentation, I'd like to talk a bit more about what other aspects of the deal with the university you covered. Are you going to be covering that later on, or?
Yes, I will. We'll get
okay.
Yep.
I've got a question here from Dan Barker.
Mm-hmm.
The question, I'll read it out. You have a great product in early stage development. I think this is setting up a scenario here. Mm-hmm. You have a great product in early stage development. You need an OEM partner for an out licensing deal and to reach markets. How much should you pay a broker to find the OEM partner and do the deal? What percentage of the deal economics should go to a broker, and the success fee only model, or retainer plus success?
Well, practically every broker out there wants a retainer plus success. I don't pay it. I pay purely on success. So I haven't paid a broker retainer yet. Unless, of course, they're a stockbroker, which is par for the course, but they're more established, they're licensed, they can go to bigger capital markets. If you're a startup, you've got very little chance of getting through the front door of a stockbroking firm anyway. They want easier deals that are more mature. So that's not a door that is generally open to a startup play. Look, if you've done your market research thoroughly, I can't see why you would have difficulty finding a potential outsourced manufacturer anyway, yourself. But again, one of the beauties of a proprietary limit or a company structure, the first thing I'd be talking about rather than paying brokers is saying, hey, subject to you delivering this, you get 5% of the company. When you've got a company, you print shares either to raise capital or to pay for services. So if the broker is serious and believes in the deal, dependent upon the valuation you've got on the business and so forth, you say to the broker, okay, it might be 5% if you deliver the outsourced manufacturer, ideally, and other factors as well. It's a bit expensive, 5% of a company, to get a phone number from somebody. So you've got to work out what you expect when you're trading out paper, and that'd be the first steps you take. If the broker wants cash only, then it's a suggestion that he's not entirely imoored with the business or doesn't believe. So again, that's a first principles play. Does that answer your question?
Well, Dan will send in another question if it hasn't, I'm sure. But anyway, yes, let's move on.
Please do, Dan. I can go to more detail if it's not enough.
Sorry, I was talking about when he was talking about OEMs. Yeah, I thought this might be the case. Original equipment manufacturer. He's actually talking about people like Johnson & Johnson, not contract manufacturing. So those big global companies that have a market already in place and distribution channels.
That's a very different beast altogether. That's like a dream come true. But actually, I'll cover that in a slide a little bit further on.
Okay.
So we'll save that question for then. Look, this is a quite a relevant slide. There's lots of guys out there, myself included, that have been around the block. You know, I can tell you 1,000 things not to do when you're putting a deal together, because I've made those mistakes, not because I'm smart. So I can say to you, yeah, don't do that, because you'll wind up losing 2 toes on your left foot, which is what happened to me. You find the right mentors, and the people are very happy to share advice and comments. It's a golden opportunity to learn by other people's successes and other people's failures. And there are a lot of mentors about that are very, very willing to sit down with you. Hey, if you take them out for a lunch and have a 2-hour lunch, it's probably the best lunch money you'll ever spend in your life. And it could be $100,000 worth of advice. But see if you can find a few guys out there that are happy to pass comment. Maybe look over your IM, look over your corporate structure. If you've got a good accountant and a good lawyer, they don't necessarily have to charge you all the time. Again, for the price of a lunch, they'll sit down and tell you where you might improve on different aspects of the way you're bolting it together. But if you can get a good mentor or two, that's a great starting point. Yeah,
look, I just have to really reinforce what you're saying there. I mean, what we're doing right now with this community is a kind of another version of that. I mean, I've had the privilege of hosting most of these webinars, and I very selfishly use them as a self-educational tool, and hopefully the audience is learning along the way. But this is like another form of networking. I'm astonished by how willing people are to share the best of the advice they've possibly got, and even to introduce you to people and build a trust network around you that will almost ensure your success. And as you only have one criteria, and that's the willingness to ask the question and make the phone call. And I have this sort of philosophy: your answer is no more than 2 phone calls away. One person to say, do you know somebody? And they'll recommend it to somebody else. And generally you'll find it within 2 phone calls, whatever answer you need to any, vexing question. So,
well, it is, Tim. And I tell you, look, the best example of that is, I think without exception, if you say to someone, I would really value your opinion, do you mind, what you would suggest I do? There's no greater form of flattery. a genuine flattery, a general a compliment. So if someone values your opinion, it's an absolute pleasure to share it with you because, basically there's a lot of ego stroking. There's always an element of wanting to share your experiences anyway. But thank you for asking me, and thank you for listening to my comments. So there's a lot of very willing mentors, guides out there, and you've just got to ask, as you just said, Tim. And it's a compliment to be asked. So, in fact, Tim, thank you for asking me to present today.
And we should just really note, in case people are a little bit confused, because I did distract with the concept of networking in these webinars. Mentors are obviously people you build a relationship with over time. Have you actually had mentors specifically to assist you in your career, Kim?
Yes, heaps of them over the years on exactly the same principle. But again, it's a great excuse for a lot of lunches, but you learn a lot over a dry lunch.
And would you have had multiple mentors at the same time to help you with different aspects, depending on their skill?
Absolutely. And because, obviously you get tax experts, you get corporate structuring experts, obviously design is another one, yourselves included. So yeah, no one's an all-rounder, or basically if they are, then they're a jack of all trades, not a king, and you want to try and get kings if you can in the first instance for advice. But mind you, having established relationships with these guys, they've come to me afterwards and bounced ideas around. So it becomes a two-way street once you actually know what you're talking about. So I've probably passed comment and looked at the deals of all of those mentors over the years and given them advice back, which they've sought.
Yeah. Okay.
So this is a bit of a classic, really. Anyone that's going to invest, so I've done deals where we put it together, I've walked in, given a 4-slide PowerPoint presentation, and someone has given me a check for 500,000. Doesn't happen very often, but it has happened. On other occasions, someone wants to put 20,000 in, and they ask you a million questions over, a 4-week period. It takes up all of your time. So you've got to be prepared to do both. You've got to be prepared to answer any and all questions. The one thing they'll all expect to see is your investor data room, right? In other words, okay, later on, oh, by the way, I've invested $500,000, but can you show me your data room? So I just want to get a few things of better understanding. So this is actually, in some respects, you can call it an investor data room. You can call it a business plan, I guess, in a way, but business plan goes into the data room. These are the things you should be addressing when you're, and your data room is a great starting point. Your company summary, your documentation to support all of that, your general investment strategy, how you hope to apply it. The team is a big one. They all want to see. So, to have your wife and your mother-in-law and your stepson or whatever as your driving team is obviously a bit of a minus. You've got to actually present competency with your team that'll make this happen. I covered the intellectual property, the previous slide. Your financial affairs, your forecast earnings. Forecast earnings, by the way, and cash flows are two completely different documentation sets. The number of guys that I've seen over the years have got some fantastic financial forecasts, but their cash flows, they're insolvent in their second month of trading. So you really have to get your head around the numbers. How that cash, you're like, okay, I've sold it. You've got to pay your manufacturer or your partner in 30 days, but you don't collect to 90 days. Then the cash required to carry stock and so forth goes through the roof. It becomes a very expensive exercise. The more successful you are, the greater the risk of going out the back door because you require more and more cash. The reverse of that is where you collect funds in 30 days, but you pay your manufacturer in 60. So that's a dream structure. Because basically you're selling and you've always got cash in the bank for an additional 30 days. So you're able to fund your growth as you go. Anyway, the data room is tremendously important. It's probably one of the very first steps you should take, not one of the last in a hell of a rush because someone's asked to see it and you hadn't prepared it. And the more you work on that data room, the clearer the direction you're headed, the clearer the actual path that you've got to take, the clearer the amount of money that you'll need. you don't just put this together and then 12 months later go back. You're working on it all the time, because when you're putting a business together, it's constantly evolving. So this has to be a living, breathing data room that reflects the evolution of your business as it's happening.
And one thing I don't, it might be under investment strategy, but I'm just trying to understand the role of exit strategy in this kind of format, because we see a lot of people who, you know, from an investment point of view, your aim is to sell the business and recoup your money, you know, once you've built the value up. Other people are building a business very much with the view of, you know, just organically growing the business over time. They have no intention of selling it. And I just note in the question and answers that Dan Barker asked a question earlier about Johnson & Johnson or people like that. You know, he says we've got some tech, but he's seeking a licensing deal. So, you know, some people might want to manufacture the product, but have a partnership with somebody or license it, you know, out to them. Where do you see all those different strategies playing out, and where do you document that?
Look, I do cover a bit more of that in a future slide.
Yeah. Okay, well, let's wait for it till then. Yeah.
Yeah. Okay. No, done. Okay. So now this is a bit of an interesting one, the cart before the horse. A few years ago, I looked at a prospectus where the guys were raising funds on a new solar panel technology, and one of the things that they looked at was they were going to raise $5-6 million. Then they were going to find a manufacturer, and then they were going to find potentially a distributor, and so forth. So basically, they had nothing in place other than a patent. Okay. In the case of Electrogenics, and I'd suggest to you it's probably not a bad strategy for most businesses, we've gone to Genesis and said, look, we plan to raise these funds, but we would like to say that subject to successfully raising the funds, you are going to be our engineer and we'll be partnering you on the technology. We've actually gone to design and industry and said we would like to, subject to raising the funds, be able to say that we're going to partner with you to actually design and develop the tech so that it's a beautiful product for people to use. We've done that with the university as well in terms of ongoing research, subject to successful capital raise. But at the end of the day, we've been able to go out and say, okay, we have distributors in place. You know, once this round is closed, everyone's ready to go. We have our design engineers, you know, Australia's leading, in place. We have our industrial design guys in place. We have our ongoing R&D research in place. So I guess to a degree, you're leveraging off the infrastructure that you've got in place, which is subject to raising the funds. Versus, let's just say this cart before the horse, you're trying to raise the funds just on an idea. So it's how you actually structure the deal up to actually not just have a patent or a concept as your core IP, but you build on that and enhance that IP by putting the right structures, and they can be milestone dependent, but they're locked in subject to that milestone. So you're only qualifying a milestone. So that's one recommendation I'd make anyway. It's you work out what you have to have in place to justify your valuation, to justify interested investors coming into the company. And again, a little bit further on, I'll touch upon a couple of the big ones that are fundamental to it. Any questions on that one, Tim?
No, that sounds very sensible.
Okay, so this is a big one. So the elevator pitch, it's all about how well you tell your story. And ideally, and I've been a victim of this, you know, personally, I've been hopeless at it for years, really had to do a lot of work on it. You've got to have someone at the end of a 1.5 minute conversation actually say, tell me more, or what about this, or is this achievable, or is that achievable? So it's got to be sufficiently interesting and attention grabbing and succinct and to the point where actually people have an interest to actually look at potentially investing in the company. If you can't get your features and benefits right and get that message across when you have the window of opportunity to do so, opportunity knocks, but it doesn't kick your door down. There's not as if you're going to get hundreds of opportunities. You just need to really work on your message, why this thing stands out, what's going to make it great, and ideally get that across in the most succinct and effective manner that you can. And the more you practice it, the better you'll get. We did as a CSIRO today at the University of New South Wales together. They had a bunch of students that had developed half a dozen different technologies. And one of the prizes the CSIRO put up was for them to go to the States to a pitch school. And when they came back, they gave this series of pitches, all 6 of them, different products, different ideas, and it was sensational. These guys just really knew how to generate, they learned very quickly, how to generate excitement, how to get their story across. Yeah, it was a great example of taking advantage of the opportunities that do present themselves and making sure it happens. So get your story right. Now this is a pretty big one.
No, just before you move on from that,
sure.
I'd add to that one of the real benefits of that is not just selling your product. We talked earlier about building your team around you. Mm-hmm. Inspiring and motivating them is just as important, but it's also just as important to understand what it is that you're trying to do. It's one of the things we do see in all of our projects is that when you have a project where you have 6 or 7 different service providers all working together to try and, assist, the company developing the product, the opportunity for miscommunication and confusion is astounding. It's I think there's a whole lot of cartoons out there where you have a picture of some sort of creature, a dog or something, and the audience, you got one person thinking it's one thing and another person thinking it's another. You just trying to bring clarity to what the product is and the direction you're taking with the product and how you're going to get there is just, it's all wrapped up as part of that.
Yeah, and why someone else should be excited about it.
Yeah.
And that's the big one. Like everything you just said, Tim, is bang on. But, at the end of the day, if you drone on and people say, well, that's fantastic, good luck, the ideal response is, that sounds fantastic, how can I get a piece of that? So yeah, it's all about how you present at the end of the day, and you can't practice enough. Spend a bit of money on your PowerPoint presentation, spend a bit of time getting it right, and practice the hell out of it. I did mention now, we talked about, so to go back to the earlier questions, right? We talk about having majors and minors and how best to approach it. I attended a commercialization seminar 10 years ago, and it changed my thinking completely. It was just such an epiphany. Basically, the story was from a very, very successful Australian company. I think they were capped at 100 mil, thereabouts. And they had developed a snoring aid, right? So or prevention device. And basically it was a mouthpiece. And they worked out that there were potentially 60 million users or adopters of this technology in the US alone, okay? But once they actually analyzed the market, they realized that that's 60 million end users that suffer from snoring wasn't really their target market. They had realized that sort of everyone that snores eventually has to go to a dentist to get teeth cleaned or filled or whatever. Snoring, so this was a mouth guard that actually was formed by taking a mold of the mouth, and it was a perfect product for dentists and an additional profit center for them. Now, if you go to a dentist nowadays, if you ask about, stopping grinding your teeth, it's about $500. They'll build a little device that breaks that grip and stops you grinding your teeth away. Apparently 90% of the wear on your teeth occurs at night while you sleep, 10% while you're actually eating and walking around in the daytime. So similarly for them, And there was like, I think from memory, 3 or 5 or 10,000 dentists across America, whatever the figure. But in fact, that wasn't their target market either. They found the second largest dental supply company in the US that had 300 reps on the road. They serviced every single dentist in America across all states. And this product fitted perfectly into their range. So they jumped on the opportunity. They had 300 reps to go because they had a new flagship product. They serviced every dentist across America, and every dentist in America had a new profit item, and they hard power sold it to all of their clients that walked in that snored. So at the end of the day, they didn't have 60 million end clients. They had one customer in the US that allowed them to access their end users and that 60 million target audience they were after. So it's all about, the summary is, your conduits to market in your channels of distribution and how you work through that. I'm personally a little averse at the idea of trying to build a sales force, 1 person and then 5 and then 20, and then they all become fixed overheads and operating costs. And they chew up 30 to 40% of the business. And so it's actually like running 2 businesses. Once you actually have a sales division, that's actually a very different business to either manufacturing or getting a return on intellectual property. So you're actually building different businesses. They all have different cost and profit centers. And quite a lot of these cost and profit centers are loss makers, rather than they can drag your average return on funds down. So conduits to market, I think that's probably the best story I've ever heard in terms of really identifying what your market's all about and how that's one technique. It doesn't fit all, but it gives you a little bit of a perspective on how to approach getting a product to market. Any questions on that slide, Tim? Oh,
sorry, I was on. No, sorry, I was on mute. Yeah, no, that's fine. Yeah, keep going. We're sort of got 10 minutes left, so we'll need to.
Okay. So we talked about getting into bed with was it not Pfizer, but Johnson & Johnson? Huh? Yep. Yeah. So look, this is probably a bit of a negative story in a way. We worked many years ago. I worked on a heat exchanger technology that was suitable for air conditioning and air circulation for food produce, cool rooms and so forth. It was potentially a $1 billion market. We took it to Hoover at the time, and the first thing they did was put 10 of their engineers in a back room to see if they could break the patent. And when they couldn't, I worked with a design engineer many years ago that was the head of design for one of the world's largest electrical appliance manufacturers. He had 10 guys under him. He said in the 10 years they were there, I think they invented 1 product. The rest of the time, the entire design team was geared around. It was geared around breaking patents. So they're just 2 devices or 2 or 3 devices in that period of time. This story goes on and on. I had an associate that developed a flavored drinking straw. They spent a lot of time getting it together. They went with one of the world's largest confectionery manufacturers. When they came back to start marketing, they found that they'd actually just knocked the product off outright, and were tied up in court. So getting to bed with a major can be great. If you're lucky enough to find the right guys and they honour the deal, then you're poised for success. But be aware there are traps involved in some of that. When we talk about the little guys as well that you're partnering with, you've just got to pick the right exposures, the right characters to work with. We had a discussion earlier today with Genesis that you can find a little manufacturer or a design guy that you take the design to, they improve it, but then they say, well, okay, the improvements are mine. And if you want to continue with your design, you have to pay me a royalty stream. That's actually a very common situation people find themselves in. So to answer your question, the ideal, I guess, is to wind up with a Johnson & Johnson in bed with a major. You just have to be very aware when you go in that that when you tell them, obviously, everyone executes a confidentiality agreement. You know, they agree to keep it secret. A better agreement to have in place is something like a non-compete, which I've got some examples of. If anyone wants one, you're happy to have send it to you. But yeah, just be aware. It's not all once you get into bed with a major or a minor, it's not necessarily clear sailing. There are risks and there are hazards along the way. But
I'm just wondering.
I'm
just wondering. You know, Kim. It sort of comes back to Dan's question. If you're going to pay a broker to do the work for you, what you flippantly said, it's a lot of money to pay to get a phone number or something, but would that be part of? I'm just wondering how you can avoid those pitfalls, because there's if you're a young entrepreneur, you haven't done this 1,000 times before, you are going to fall into those traps unless you've given some examples, but there's a huge number. You'd be wanting to work with somebody who's very experienced and aware of those sort of traps and is working on your behalf to optimize it. So is that something a broker can offer you, or how else would you avoid these pitfalls?
They're just identifying your targets. At the end of the day, if you can execute a non-compete, non-circumvent, where they undertake to listen to your ideas, work through with you, and they won't seek to knock you off. There's a bunch of examples here. I might dwell on this for a few minutes. So there was a great example a few years ago. Was working with some patent attorneys, and they had a guy that had developed a new ballast for fluorescent tubes, fluorescent lights, which used a third of the power. And they signed the exclusive manufacturer marketing with one of the world's, I think they were at the time, the world's largest ballast manufacturer for fluoro lighting in the world. And these guys just put his technology in a bottom drawer and did nothing with it, because they didn't want to alter their production line. They already had major market share. They'd effectively signed him up so they could get him off the market, and did nothing. So he was complaining. He was trying to get these guys to move on it. They went back through the commercialization agreement, and one of the lines his lawyer put in was that this major company would use its best endeavours to commercialise. There's two magic words in the best endeavours in the documentation. He took them to court and was able to show that they had failed to use their best endeavours. In fact, they did it to sit on the tech. They put no endeavour into it. And he managed to get his IP back, and plus, I think it was $60 or $70 million in damages. But I mean, again, that's the risks you take with some manufacturers. So not seek to circumvent. Best endeavours is another little example of. We did one with an Indian manufacturer a while back where we outsourced product. And this was a design for a water turbine. And they're a $1 billion company. And they delayed delivery for about 18 months. It just went on and on and on, and customs problems. Later on, it transpired that they built 4 additional units, taken them into different areas and been trialling them themselves with a clear intention of actually just knocking it off outright. And their approach was, hey, it's going to cost you $5 million in court. You're a startup. Good luck. Technically you're in the right, but let's see if you can raise the 5. Otherwise, you're out of the game. So it's fraught with risks. But again, every now and then you walk in, you shake hands with the head of a company. Their word is their bond, and their reputation stands or falls on it, and you've got a dream deal. So you just have to weigh up the dwarves and the giants, and make your best guess at the end of the day, or leap accordingly.
It's a pleasure, drawing in your experience here, Kim, to give the advice to everyone. I've got another question from Luke here. Let's say you have an existing technology from uni with IPs, I think he means, and prototypes targeting a mature field. Does it make more sense to set up a company to bring up to market, or would it be easier or possible just to sell the IP and the technology to an existing medical device companies in the same field? What are the pros and cons of each? And that's again what I think Dan was doing. He's got some tech, he's looking at a licensing deal. So set it up, or
okay. So licensing is a different thing rather than partnering. So I've misunderstood that. Yeah, look, licensing is a great way to go. But if the university has got the tech and the IP, that's what universities do. That's their first port of call. They actually approach everybody and say, who wants to license the tech? They're not going to make it themselves. So I don't see how you're going to get an opportunity to control that IP and then put a margin on top and license it somewhere else and get a cut off it, because that's normally what universities do. But yeah, licensing is a very, very, very sound strategy if you've got IP that is protectable, ideally covered by a patent or a patent pending that is likely to get up at the end of the day. Maybe a little bit of black art. It actually works quite well. I think as Coca-Cola, still nobody knows what the recipe is. It's still a secret. Or so the legend goes, anyway. Hard to believe.
But one of the things that's really striking me here is that there's new legislation in Australia around the patent box legislation. Have you heard about that?
Yeah.
Yeah, and so that's a designed to encourage people to develop more IP and make revenue from I believe from licensing. If people just Google patent box legislation, you'll get a lot of interesting information on that. But let's move on.
Mm-hmm. Okay, so that's your majors. So this is what our tech's all about. And where we are at the moment is in no small measure as a direct consequence of engaging Genesis first and foremost, and then obviously design and industry. So I've covered the university had this technology. We went to them and said, okay, this is actually a little bit important. They're looking to commercialize, but once you actually sat down to talk to these guys, that wasn't their hotspot, okay? Their actual hotspot with seeing this stuff commercialized was that the university would get credit for having produced product that was ultimately commercialized. Not so much the returns, they weren't all that fussed about how much money they made out of it, just that their institution was producing stuff that was going to market. It justified them as being educators and made them a more attractive institute for potential new students. So that was their biggest hot button in this. The next, obviously, to see if there is any commercialization upside. So we carved a deal. A lot of these guys try and shoot for 6% of sales and crazy numbers, which is very, very expensive, and they don't see a lot of them get up. We actually gave them 12% of the company, so we traded partial paper, and then did a 4%. At a hindsight, 3 would have even been better. I think they would have worn that. But so they're part equity, part royalty stream. That actually worked much better for them. They got to take the ride on a number of levels, and that also allowed them then, another hotspot was to have their research department, so their professors, continue as an ongoing consultation role. And so there was just a lot of buttons that worked for them, independent of just getting a license to commercialize the tech. So we really had to sit down and see what they were really after, not what they said they were after at the end of the day. We dropped that into the, I mentioned earlier, into the, in this case, an unlisted public company structure. If you do a proprietary limited, that's definitely the best way to go, because you can always upscale a proprietary limited to a public company, unlisted public company structure down the track. You just change the classification. If you start off with an unlisted, as we have done, then you are subject to audits, and it's just a little bit tougher. The reason we did it was because we had a 12-month to 18-month plan to go very, very quickly to IPO, because we know how to do it. But if you don't, then a proprietary limit is good enough. So you get your structure right. I mentioned earlier, in our instance, we went to Genesis, DNI, Point Blank are our distributors, great guys. They see massive potential for their immediate client base in this, getting it out there. That was all conditional upon the subject to the capital raise to proceed. So put together the right team that underpinned the value, not just the 8 million, but just the strength of the participants. We've got a strong board as well. The guys have a lot of background and experience in commercialization. 3 of us on the board have got experience in startups. So yeah, that's a pretty fundamental ingredient at the end of the day. And everybody has been around the block several times, so we've all made mistakes as well. And of course, the tech itself. So we've looked at the market, we did our market analysis, and I guess the punchlines are this tech is better, it's cheaper, it's easy to use, it's clinician friendly, so just a bunch of commercialization hotspots. It's a breakthrough product. Okay. What these guys, one of the comments one of the nuclear medical physicists made the other day was that, wow, all the equipment they're using now looks like it's come out of a 1950s laboratory. They can hardly wait to get their hands on something like this because it looks like they're working with 21st century technology. That this was design and industry's input. So yeah, this is that classic example I gave at the very start of this discussion, where we have a mature industry and we're coming out with something that's better, cheaper, easier to use, and is poised to put that particular industry on its ear. So, and again, we've built, and another question was raised earlier. So we have a long-term design goal with this company to see it a very successful company, but we think, in fact, the way it's been put together, it's likely to be a very attractive early trade sale as well, and we're amenable to both. But we have built this to be a long-term business with the expectation that it'll be snapped up pretty quickly by one of the majors that wants this sort of flagship product. And that's actually my